Good morning, everyone. Good afternoon for the people who are in Argentina. Thank you for joining us today. My name is Daniel LaRocca. I am president of the Austin chapter from the Argentina-Texas Chamber of Commerce, and I will be your host and moderator for this session. On behalf of the Chamber, I would like to welcome you to this webinar on how to invest in commercial real estate in the U.S. Before we dive into our webinar topic, let me take a moment to introduce ourselves and give you a brief overview of who we are and what we do. The Argentina-Texas Chamber of Commerce is an independent, nonprofit, voluntary membership association founded in 2016 with the objective of promoting investment, trade, education, and networking opportunities between Texas and Argentina by acting as a catalyst for innovative, ethical, and productive business relationships. As part of our mission from the Chamber, we constantly work to strengthen business opportunities and relations between Argentina and Texas. And this initiative is part of that intention. We would like to express our gratitude to our corporate members for their contribution, support to the Chamber, continued support to the Chamber. Without them, of course, these activities will not be possible. And they are Pan American Energy, Gold member, Duralight, Globant, and PCR, Silver members, as well as AESA, Mayer Brown, Practia, ProShale, and Q Advance, Bronze member. As most of you are familiar with the webinar protocol, we first would like our speaker to leave his presentation, and we kindly request that you save your questions and concerns for the end of his presentation. Feel free to submit your inquiries in the Q&A chat, and I will be more than happy to relay them to the speaker once he concludes his presentation. In this webinar session, How to Invest in Commercial Real Estate in the U.S., we will explore the foundational concepts and principles of commercial real estate. We will dive into the financial metrics used in commercial real estate analysis, evaluating its risks and decisions to finally get us into a case study on how to invest in the U.S. Now, don't panic. For this, we have an expert. We count on Rod Allub, who is an authority in the field of commercial real estate. It is an honor and a privilege to have Rod Allub as a speaker today. Rod has represented over 2 million square feet of real estate transactions in the state of Texas, with a primary focus on industrial business parks, office, and retail asset classes. He holds a master's degree in business administration, class of 2006, with corporate finance concentration from the University of North Carolina at Chapel Hill. He has completed executive education in financial risk management at Kellogg School of Management. He serves as a president of Houston Equity Partners, a Houston real estate company, and also he is president of the ATCC Real Estate Committee that holds a real estate broker license in the state of Texas. So, ladies and gentlemen, with you, Rod Allub. Thank you, Rob. Your screen is all yours.
Well, good morning, everyone, and thank you, Danny, for the generous introduction. And thank you all the participants for joining today. It's always a pleasure to share these training workshops with our colleagues and friends in the Argentina-Texas Chamber of Commerce. So before we start, as Danny mentioned, I am one of the managing members of Houston Equity Partners. Houston Equity Partners is a real estate investment company that allows accredited investors the opportunity to invest in industrial, retail, and self-storage assets throughout the Houston area. Some of our past projects, real estate investments, have included mainly, you see here in this slide mainly industrial multi-tenant business parks that range between 50 to 200,000 square feet in size, with internal rates of return that have ranged between 8 to 22%. Company has several investors from several countries and has syndicated in transactions in excess of 800,000 square feet. So with that said, I'm going to jump into the actual content, for the webinar. I'm going to be covering a couple of topics. We're going to start with what is commercial real estate. I'm going to cover how are commercial real estate assets classified, the basic financial metrics. We're going to discuss how typically a manager for a real estate project creates value for the project, for the investors. We're going to discuss the typical deal structure that you see in real estate transactions in the US. And then we'll dive into the why, when, where, and how to invest, to finish with a simple case study of something that we have done at Houston Equity Partners that focuses mostly on the where, so with asset class and how to instrument an investment. And it's a case of Houston industrial multi-tenant project. Okay, so with that, what is commercial real estate? So very briefly, commercial real estate entails property exclude for business-related purpose that pursue hospitality, industrial, retail, and self-storage. You'll see that within industrial and retail, there are two sub-classifications that are very different in nature. For industrial, you have the logistic business parks, which are large, big box buildings with typically single tenant, versus the industrial flex, which is a subset of the industrial asset class. The industrial flex is more the smaller type of warehouses with multi-tenant type of facilities. And retail is very similar. You have the big box shopping malls versus the small retail strip centers that serve between 10 to 20,000 square feet that serve a local community, things on those lines. So this is the basic classification: multifamily, office, hospitality, industrial, retail, and self-storage. Going to how are commercial real estate assets classified. Typically, you'll see in reports, analyst reports, you'll read about the classification by quality and a second set of classifications that are by investment strategy. By quality, there's no hard line, but typically you see classes that classify the real estate assets between Class A being the best, highest end, newer construction, all the way to Class C, which are the older product, the older type of buildings, less desirable, older construction. But there's no fine line between Class A and B. It's very fairly intuitive. Class A is the best asset class, Class C is the least desirable. The classification by strategy, we'll see this is a little bit less intuitive when you read the definitions that real estate practitioners use. But in general, for a simplistic view, you see them classified between what is denominated as core, value add, and opportunistic. Core or core plus is typically an asset that focuses on capital preservation. So this is the best asset class, no risk, 100% occupied, Class A, new construction with a credit tenant that has an excellent credit. This will be a logistics, an example, a logistics building leased by FedEx. So very little, with no vacancy, very little risk. So it's focused mostly on capital preservation and therefore low growth, but that's what typically is denominated as core. You have value add. Value add projects are typically projects with that has or carry moderate appreciation. Some work has to be done. An example of this is would be we've invested in business parks that are probably not 100% occupied. They have tenants that are not the best credit out there. So typically you come into a project where it has maybe 70-80% occupancy, and the proposition from the manager is to bring that occupancy to full occupancy, either increasing rates or increasing occupancy to add value. So it's an investment class that will entail moderate capital appreciation with a little bit more risk. And at the end of the spectrum, you have opportunistic. This is capital focus here is high appreciation. Obviously, that carries a higher risk and higher upside. But here, a good example of this, a project that we've done that we will define within this bucket would be an acquisition of a completely vacant building that is redeveloped or repurposed for multi-tenant, industrial multi-tenant. So a manager will go in, find a construction loan, find the architects, repurpose it, all the way to stabilize it, finding tenants to stabilize it, to convert something that was vacant into a core plus type of product. So here's the spectrum. You go from fixed income, the lowest risk, lowest expected return. You go to core plus, then you go to value add, and having opportunity at the end of the spectrum with the highest level of risk and obviously the highest expected return from an investment standpoint. Okay. So next slide is the basics of financial metrics. Basics of financial metrics in a real estate, in a commercial real estate transaction, it's no different than any other business. You have a profit and loss and net cash flows. And then you have a series of indicators that are very specific to real estate. The profit and loss you have is your typical operating income. In case of real estate, is rental revenue, and subtract all the operating expenses to get, and you get to this metric. This is called the net operating income. This is an important metric for real estate transactions, the net operating income, and we'll go into this in the case study. But net operating income is the gross profit after normal recurring expenses. Then you subtract the capital expenses and debt service, and you arrive to your net free cash flows, which is the excess cash flows that a project can render and distribute to equity investors. So for the indicators that are useful to keep in mind when analyzing or looking at a commercial real estate project, the first one is the cap rate. The cap rate is by definition is the net operating income of the property divided by its sales price. So what does this tells you from an indicator standpoint? It's, for us, it's a proxy of unlevered returns. Unlevered meaning it's what the property, what the project renders in return if it was purchased or acquired without debt. So proxy for unlevered return. The cash on cash, then it takes now into account the debt. So by definition is the net annualized cash flow, this portion over here, the net cash flow after paying the debt holders, divided by the equity that was invested in the project. So that gives us a proxy of the annual yield as investors that the project will render after debt has been placed into the project. Okay, so an example, I'm an equity investor. Somebody tells me, well, the investment 100,000 will give you a cash on cash of 8%. would expect to have an 8% of my $8,000 a year in cash as a yield throughout the life of the project. The next indicator that is relevant, very relevant in commercial real estate projects, is the debt service coverage ratio. And I know some of the folks here in the audience have more financial background and banking background. This is probably one of the most important metrics that we look at in a project. This, by definition, is the net operating income divided by the debt service. But what this tells us is really the risk that we're taking in the project, given the debt level that we have decided. So it's how cash flows cover the debt obligations. And you typically see on a safe product, on a safe project, that ratio to be between 1.5 and 2.5. So we want our debt service to be covered at least 1.5 times by our normal recurrent income from the project. This is what banks typically like to see. They like to not be anywhere close to 1. So what we found is 1.5 is a safe debt service coverage ratio, and ideally will be over 2. So this is the range that we like to be at. If you find somewhere or a project that has a debt service coverage ratio too close to 1, then you may want to start raising your eyebrows, because you have more risk than what you would normally like to take. Internal rate of return is, everybody I would assume is familiar with that term, is what discount rate would cause the net present value of a project to be 0. And finally, the equity multiple. The equity multiple is very used in real estate. It's a very simplistic and straightforward way of measuring the return for an equity investor in a project without any concerns on discounting. So how many times my initial equity will grow from start to finish on a project with no discounting. So typically what you see in real estate transactions is, at least in the asset class that we work with, is between 1.2, 1.3, all the way up to 2x, 2 times. That means a 1.4 equity multiple means I've invested $100,000 today in a project that has a lifespan of, say, 5 years, and the expected equity multiple is 1.4. I would expect to get $140,000 back when everything is said and done, when the project is liquidated. That's what the equity multiple conveys. Okay. Value creation process. So wanted to touch here on how the managers can create, or typically a manager, a real estate manager in a project or a sponsor creates value for a project. So I would expect a good manager to go through these 3 stages of the lifespan of a project, to work from the deal search to de-risk to stabilize, all the way to hopefully create a good outcome or a positive outcome, or optimal exit price for a project. The deal search managers, typically what you would expect of a diligent manager, would be to have good local networks. It's very important in commercial real estate to have relationships, local relationships with landlords, lenders, and brokers. Why we say this? Typically, just to get assigned a real estate contract in commercial real estate, typically the counterpart will want to see how or what other transactions you've done in the past, what relationships, what other assets you manage, or what relationships you have with other banks. So lenders is the same. Lender will want to have and see the track record of the manager. So all these things are very important and add value to the project from a management perspective. Manager will expect a good manager to be knowledgeable on the market, so perform a diligent due diligence before acquisition. what this entails, a good manager will probably have a good sense of the market. You see a project, say, for example, that has a very attractive net operating income, but has rates or rental rates that are significantly above the market rates, then even though you have the income, you can, by knowing the market, the manager will know there's downside risk in that project. On the contrary, if you see, you know the market rates, you know the asset class, you can identify that there's upside in rental growth. And that's part of the due diligence that's done before an acquisition. And also the manager during the de-risk stage will be determining the proper debt strategy for the project. Stabilize the work of the manager. The mission of the manager is through stabilization is to reduce cost and increase revenue and manage that debt throughout the life of the project. So hopefully after all these activities, you have a long-term value in a project with solid cash flows, dividends through dividends and refinancing. And hopefully all of these efforts lead to an optimal exit price and a good rate of return for the investor. Deal structure. What we wanted to touch on this slide is how, and there are many ways to structure a deal between managers and investors, but what you typically see in the real estate industry in the US is this concept of management. Somebody will manage the project from start to finish. Typically, the manager will invest, as any other investor, under the same terms, between 5 to 10% of the equity, and they will be signed as for the debt recourse. It will be the sponsor, what the banks call the project sponsors. They will guarantee from a personal standpoint, the debt that the project takes. In exchange, what you see in the deal structures, you have a concept of preferred returns and management promotes. So the preferred return is typically, in real estate, ranges between 4 to 8%. The preferred return is the minimum return for the equity before any profit sharing can happen with the management. So typically, just for sake of example, the initial equity investment is $100,000. The project offers an 8% preferred return to the investor, and the project at the end, after everything else is said and done, has cash flows of $110,000. So 108, so it's the principal plus 8% goes to the equity investor, and after that, the last $2,000 in this example is distributed, or would be distributed as cash flow subject to profit sharing, which typically may be a 50-50 or 80-20, 70-30. So that profit sharing is called in real estate is defined as management promotes. So the manager only gets compensated if he did every single stage that was supposed to do to generate returns above and beyond this preferred rate of return. Okay, that's how typically transactions are structured in real estate in the US. This next slide, why to invest? So why we should be investing in commercial real estate? Well, it's many asset classes, but we like this chart. This is a green sheet commercial property price index that shows an index of commercial and unlevered commercial real estate property values throughout time. Even though it's an illiquid product, somebody tracks it in the form of an index, and we see this chart. What it shows us is many years of positive long-term trend. However, it does show cycles. So here we see on the left side, we have the 12-month change, the left axis. In the right, you have the index value, how the property values have performed. Long-term trend is it's been favorable with cycles like the global financial crisis. We see here a drop during the global financial crisis. We see here a drop during COVID on all asset classes. And we see here a peak in March 2022 with historically low interest rates. And then we start to see a correction here, which is the start of the Fed tightening of interest rates. So bottom line or takeaways from this slide is, despite cycles, historical long-term trend in commercial real estate values have been favorable. And we say our conclusion on this slide is opportunity really arises from the ability to hold quality assets long-term through the cycles. Okay. So touching more on the cycles, this slide tries to discuss or get a sense of when to invest. When is the right time to put our capital to work? Is it at the beginning of the cycle? Is it at the bottom of the cycle? Well, these two charts show two things. This one, the left side chart has the property values, and these are property values for globally, not just the US. It's a chart of property values throughout the world compared to these treasuries. And we'll see that the property to track the yield tends to track the yield of the 10-year treasuries. The higher the yields on the 10-year treasuries, the higher the expected return on the commercial real estate property. And yields move opposite with values. So the higher the yield or the expected yield, the lower the value of the underlying asset. So what this chart shows us is there's no way to escape. When interest rates go up, yields must go up, and property values need to adjust. This chart shows an interesting pattern. Compares the pattern, the cycle, or the changes in value for commercial real estate values during the last global financial crisis in 2008. Here, this chart, and where we're at right now after the pricing, the yield increases globally. So what analysts are saying is yields are rising in most parts of the world, and so far the path of repricing is mirroring the global financial crisis. Government bond yields have moved higher in the past year, and real estate must offer a comparable rate of return to compete for capital. When to invest is the question that we're trying to ask. And our answer is, we don't know. It's very difficult to time the cycle. You just need to know where in the cycle you are at. We know there's been in the last 12 months price reset, a price adjustment because of high interest rates. There's no way to escape, but we know we're not here. We know the price adjustment has already happened, not in the US, but throughout the world. And the decision on when to invest is really very difficult to predict. Is it here? Is this V-shape going to reverse now and start here? What we do know is that prices or values tend to adjust very quickly, and there's no time for the V-shape. As happened in the financial crisis, you see the deep decrease and deep recoveries. Happened in COVID. It's happening now, and we don't know when this will recover. So when to invest, again, we go back to our thesis. The opportunity really arises from the ability to hold quality assets long-term through the cycles. Don't try to predict the exact moment, because it will be very, very difficult, if not impossible. Okay, this slide just shows this is an expansion of this slide that shows where we think we are in the cycle. And it shows that it's not only in the US, it's not only in one asset class, but really all of them: office, retail, logistics, apartments, all down compared to the global financial crisis. And again, it's a consequence of government bond yields going up throughout the various markets globally. Where to invest? When we look at where to invest, now we can make a little bit better decisions, because now we can make a more educated decision if we start looking at the different patterns and the different macro trends. So you have the various asset classes: multifamily, office, hospitality, industrial, retail, and self-storage. And we see this, we like to track this Green Street commercial property price index. And they go through the effort of breaking down the property values. This is now the US, by asset class. Very important to know the asset class. So we put together this graph. We started breaking down the different phases that we see, that the big themes and events, market events that happened throughout the last 10 plus years. And we see a couple of interesting patterns. First one that we identify here is what we call in this chart is the Amazon disruption, or the e-commerce disruption. What we see here is from 2016 and before, a tremendous difference between the industrial asset class here in blue, and versus the offset is here, the malls. So this was a significant disruption in the market. People started not buying or going to the malls, but buying remotely, buying in an Amazon, buying in an eBay. So things, and the market that created a market disruption that is very difficult to fight. The malls asset really never recovered, and we don't expect that to recover. This has been a significant change. The other pattern here that we see is the start of COVID and environment of 0% rates. We see at the start of COVID, every asset class going down in value, regardless. There was no light at the end of the tunnel. Nobody knew what was happening. So every asset class, regardless of economics, went down for a while, until 0% rates started to kick in. So we see the start of the 0% rates driving asset prices up. And you see every single asset price, regardless of economics, going up in value, going up, regardless of economics behind it, driven by 0% interest rates. And now we have an interesting point. 12 months ago is the Fed tightening. Start to see the Fed tightening, and now a different era, a different cycle starts. Every single asset class down, no matter, nobody can escape. Some of the ones with worst economics hitting the worst. And we see here office, for example. Here we see a theme, which is the remote work. Similar to the Amazon disruption, we see this, people not going 100% back to the office, and now exacerbated by Fed tightening. The office, it seems to be going through a similar market theme with all the wrong indicators. Another thing to note here in the chart, the only asset class, despite the Fed tightening, trying to recover its footing, is industrial. So we see it here with a little bit more detail. We see the 12-month change. We see only industrial really getting its footing back, despite the Fed tightening, and office in free fall. Just last month, just 6% drop in property values. We see here the past 12 months gives a better indication. Office hitting the worst, 27% drop. That's significant. It's very, very significant. 27% drop in property values compared to apartments hit relatively hard as well. It went up too fast, too quickly, 16%. And then you have the asset classes that we as Houston Equity Partners like the most. Industrial, yeah, hit. There's no way to escape, 2%, but it's not too bad. Down 8% from a recent peak, but manageable. And then we see street retail, really relatively stable, hidden but not as hard as industrial, and self-storage, yeah, down 5%. Definitely here the blood is in the office sector, and somehow in apartments. So here's how we weigh the where to invest. Industrial, we like it, has proven, has a theme that goes in favor. It's fighting recessions, it's fighting the market, it's getting its footage back. Self-storage the same. Strip retail is different than the malls. It's not the same retail. The mall is the big box. It's gone through this market disruption. We don't like as much the mall asset class. But strip retail, you see it here down during the pandemic, really stable throughout. The retail is a small service center that people need. It's in the corner of your home. They continue to exist as long as a pandemic doesn't close them out. It's an asset class that is relatively stable. Okay, so this is our view on the different asset classes in the U.S. So next topic is how to invest. So once we have decided, well, I like whatever you have decided, I like industrial or retail, then how do I invest in industrial or retail? Well, there are a couple of options, and it becomes a matter of personal preference. Do I invest in partnerships, or do I go individually with no partners and buy the strip center by myself? It's a matter of personal preference. What we do have listed here is the pros and cons of a partnership. So what we think the pros of investing through partners are, number one, it's a reduced capital requirement. You don't need to come up with $2-3 million to get a deal done. You syndicate with a couple of partners. You take less capital at risk. Number two, it requires no personal debt, because now we're going to a project where one of the managers will be the sponsor. He will manage the project, and they will take debt on behalf, and they will guarantee the debt in front of the lender for the project. So it's one thing less to worry about. You can rely on expert management. Perhaps your main line of business is medicine, is something completely different to real estate, and you don't have the expertise to know if you're buying a plaza or a business park that has low rates or high rates, or if you will be able to lease that space in the current market conditions. So you have the ability in a partnership to rely on a manager that will do that for you. And this all simplified in being able to passive invest. The cons of a partnership are less control. Definitely the less control. You have more control if you go as an individual investor. So those are things that you have to weigh in, whether you want to do it on your own or a partnership. We think partnerships are a good solution for this size of investments. Then we have the option of the ability to decide versus a real estate investment trust, public or private. REIT is retail investment trust is no different than buying a stock. The advantages are extremely liquid. You go to a brokerage account, you invest in a REIT, then invest in industrial, you buy Prologis, and you're done with it. Requires very little or minimum investment, as any stock purchase would. The cons are that it really has that higher volatility. More liquidity comes with higher volatility, and therefore allows those short-term decisions sometimes, which may catch the investor in the wrong for the cycle, or with taking emotional or irrational decisions. And this graph shows this fairly interesting. This graph showing so the average 3 recessions, and the public markets typically outperform by a wide margin coming out of a recession. My opinion is not that the public outperforms the private. My opinion is that this is a consequence more than the economics behind it. It's a consequence of higher volatility. People react higher, faster, and wider value changes when you have the ability to liquidate an asset. So they tend to react more to recessions than a private partnership. You don't see the value of a private partnership. So that's why, yeah, they perform better, because during the downtimes, they move wider in value. So I think this is a consequence, more volatility than the underlying asset class behind it. The asset class is the same; it just moves in value more widely. Okay, so these are things that as an investor you want to weigh in. How do you want to invest? You want to do it public, private, or you want to go with your own investment, or do the partnerships? I'm going to focus a little bit on the partnerships now, just to expand a little bit. If you wanted to do it with a partnership, so the typical sources of funds would be, so any other investment. You can invest from a savings account, trust, your 401k. Houston Equity, we've got accredited to invest as a 401k or retirement vehicle. You can be an international investor and decide to invest your excess cash in something more tangible than just a stock. And the way we typically see this instrumented in any private offer memorandum will be with a written, at least in the US, will be with a written private placement memorandum. This is the document, the master document that states all the risks and rewards and all the SEC disclosures that are required for the specific investment. You would typically sign a subscription agreement. You would find joiners to the operating agreements, the LLCs that are formed to start the project. And finally, in the US, you typically have to sign something that's called the Accredited Investors Questionnaire. The SEC defines an accredited investor as someone who has an income over 200,000 or a combined income with a spouse of 300,000 or $1 million in assets. So that's an SEC definition. So you'll typically just populate a questionnaire in this regard that comes with this set of documents. Okay. So that's why, where, when, and how. So what we tried here, just to try to finish the thoughts, is how do we put all of this together? How did we do it at the Houston Equity? And we decided to put 2 or 3 slides here to show a case study with the where to invest and how to invest. Our case study here is it's an example of a private equity investment in Houston multi-tenant asset class. So we started the things that we like about industrial. We've seen really industrial has been a resilient and flexible asset class. It's gone through, we've seen the charts, it's gone through all the storms that we can think of. It's been resilient, flexible, and we like it. The historical vacancy rates, at least in the Houston market, have been low. We like the fact that the asset class has the lowest rents that allow for appreciation over time without putting too much strain on the tenants, which are the main source of revenue. And we like within industrial, we like the multi-tenant. Multi-tenant provides an additional layer of diversification, because now we're not subject to one credit, one industry. We're subject to multiple industries and multiple tenant credit ratings. Okay, and finally, it has a nice spread between financing rates and the cap rates that the property renders. So this is how we put an analysis together from top to bottom. So we go and say where to invest, trying to answer where do we invest? Where can we go? First thing that we look at is the map, the US map. And we like to follow where the demographics and demographic growth is in the US. So we have this map with population growth, and we see Texas, the darkest that it can get, closer to 20% population growth since 2010. This is huge. We like Florida, we like Texas, but we're in Texas, so we select Texas as a good place, macro level, to start our search. Second thing that we see within Texas, where do we go? Do we go to El Paso, or do we go to Houston? Well, we're in Houston, and we like Houston. We see that the city is one of the fourth U.S. largest cities in the U.S. Is the 26th largest economy in the world. It's the energy capital of the world. It has diversity of industries, aerospace, medical. It has economic growth, access to a port, everything, you name it. Everything is in Houston. Most people are not really familiar with Houston. Typically, you hear, as an international investor, you hear a lot more about Florida and Miami, things like that. But Houston has for the last 20 years that we've lived in Houston, the growth, the potential that the city has is very, very powerful. Because we like very much Houston. Then we narrow down the case into get more granular. Now we want to know the industrial. We like industrial, and we chosen Houston as a target. So now we go deeper and want to see the market fundamentals for Houston industrial. So we typically see, when going to a project, we see all the indicators. We see development, we see net absorption, we see the asking rates, we see vacancy and investment sales. All of these indicators we like to see and understand if this is a favorable market. We focus on two of these six. The most important to us are, number one, rents. What have rents been doing during the past couple of years? And we see that a trend since 2016, 2017 has been upward trending. It started with 6, now we're 8. So we like the trend on the interest rates, on asking rents, because that ultimately would drive the value of our property. Higher rent, higher value at exit. And then we like to see, and we pay very close attention to this, is the vacancy rates. Vacancy, we don't try to fight market trends. We like things that we can ride through the cycles with vacancy. There are things that we don't control, but we can control at least which asset class we think will have a stable vacancy rate. And we see that industrial historically has been below 6%, except for here a jump in COVID, which is, well, no exception. Nobody could escape from this. But historically, we see an asset class with good vacancy rates, low vacancy rates that allowed me to make my rent, my debt service, and ride through the various market cycles. And finally, investment sales. We see that the investment sales people are taking note of this and are investing in this market. They started here at $60, $70 an average for the sales price per square foot is going up. So people and institutional investors are taking note of this. We like the market. This continues to prove our thesis that Houston industrial is a good place where invest our capital. We finally decide that we want to invest in Houston and do a case study, do a multi-tenant, find a multi-tenant, which further diversifies our risk. We go to our broker, say, your broker, here's our track record. We would like to get this property under contract. We like this property, it has 9 tenants, further diversifies my risk for credit. And now I'm in industrial where I want to be, it's in Houston, and it has multiple industries as a source of revenue. So we like this, get this property into contract, and we put it all together in the financial metrics. This is how it looks like when we present it to our investors, our partners. Folks, we have this project in Houston. It's an 80,000+ square feet building with great frontage to the highway. It has a great location. The cap rate, which we already discussed, is about 7%. The property cost about $11 million, and it generates an EBITDA or net operating income, which we already discussed, of $763,000 a year. So we put all those metrics together, and we decide that to be able to buy, we need to go to one of our banks, one of our lenders, and request them 70 or 60% of the loan value in a loan, and then we'll need some equity partners for $4.5 million for the equity. We look at the project on a 5-year term with a 5-year horizon. We conclude that with this loan, based on the 1 year to 3, we're going to have a period of interest only. So our debt service coverage ratio, which we already discussed, during the first 3 years will be very, very safe, very healthy. We said 1.5 was good, 2 was very good. We're at 2.8. We love this is a very, very safe investment. So we decided it's a good investment, and this debt service ratio with now performance that between year 4 and 5, when we start to amortize that loan, it will drop to 1.7. Still safe, but something that will come sooner or later, because we not always have an interest only period. So with all those indicators, we tell our partners that the expected return will be equity multiple of 1.45x. That we expect throughout the life of the 5-year term, we will expect to have an 8.32 cash on cash return, at least during the first 3 years of interest only. Then it drops after you start amortizing, but in the first 3 years, an 8% cash on cash is very, very good return. And after everything's said and done, and we sell the property at the price that we think will be sold in 5 years, after some assumptions on cap rates at exit and so on and so forth, we expect that this project will render a 13.27% rate of return for the investor. Okay. How do we put all this together from a legal standpoint? This is how the banks like to see the structure, and this is how we typically put our structures together. We have our capital stack. This is how it's called, capital stack, how we allocate and the different sources of capital. We said we need to raise 12.5 because we need a little reserve, which will be made of first the senior debt. Our bank will lend 7.5. We as managers, because we trust and like this project, will invest $500,000 JV equity, and then 4.5. We're gonna talk to our partners that may be interested in the project, and we will implement the investments. So how to invest with the accredited investors and high net worth and so on and so forth. We will sign all these documents we discussed previously, which are the written offer memorandum, the subscription agreements, and the joint to operating agreements, and we'll raise the $12.5 million to get the project going. The entity structures typically look something like this. The investor comes into a clean LLC that only carries the equity investor in investments. We have an operating LLC that typically is only deals with real estate brokerage services, with property management, with tenants, does all the operating activities and holds the real estate. This is how the banks like to see it. They like to see the real estate held by a special purpose entity just for the purpose of holding the asset. And then in a separate entity, we have our management LLCs where they manage the day-to-day as we discussed, trying to add value to the project, gets the promotes on and so forth. This is the legal structure, and this is the capital stack that justifies or puts everything together in the how to invest. So final conclusions, really summarize everything that we said in 5 bullet points. The first one, commercial real estate prices have reset lower over the past 12 months, following higher government bond yields. There's no way to escape. Higher yields derive lower property values, and there's nothing we can do about it. If someone tells you otherwise, don't trust them. Timing, the exact bottom of the cycle is uncertain or impossible. So again, keep the eyes on the horizon. Despite cycles, historical long-term trend and commercial real estate values have been favorable. It's a good asset class. It has played well for us as long as you can keep your eyes on the horizon. Partnerships allow low volatility, passive investing, and reduce capital requirements. We like to use them. It's a good vehicle to facilitate this type of investments. And finally, and probably the most important one for me, is industrial and self-storage have outperformed most asset classes for years, with malls and office underperforming due to disruptive market shifts, the e-commerce, Amazon effect, the work from home. These are macro trends that you need to know before investing. And in our view, at least my view, I would avoid fighting them. There's a reason why I like to avoid fighting macro trends is so many years ago in another presentation, a phrase from someone a lot wiser than us, John Maynard Keynes, said, "Markets can remain irrational longer than you can remain solid." That's why we don't like to fight macro trends. So key takeaways, if I have to summarize these these 5 in only 2, would be eyes on the horizon and avoid fighting macro trends. All right, so with that, Danny, I'll hand it over to you.
All right. Wow. Thank you so much, Rod, for this presentation. It was amazing. And so we don't have much time, but I have a couple of questions. And one is, what is the minimum ticket size required in a partnership private investment?
Yeah, we get that question a lot. It depends on who puts together the transaction. You have folks that would put a deal together and may offer, and we've done it all the way to $10,000 to $500,000. It depends on the ticket. We have seen, and our experience has been that probably, I would say, something that justifies the administrative effort of doing tax returns, keeping an LLC open, so on and so forth. Would like to see that between 150 and to 500,000. That would probably be a good range for a minimum ticket.
Okay, well, I have a couple of questions more. Enrique Garcia is asking, what is the difference between property sales price and invested amount in the cap rate and the cash or cash return?
Well, the two indicators that we have was the net operating income one. One was, and we go back to this slide. The main difference here is in these indicators here. So when we go, there are two main indicators. One has debt, and the other one doesn't. Assume doesn't have debt. So the capital rate, the capitalization rate, is the return that you would get or that you would expect to get in an asset, assuming it has no debt. Is how much the property is generating divided the sales price if I called no bank to purchase it. In our example, we had, I think, a $700,000 net operating income in our case study, and an 11, say, let's call it just for sake of math, around $10 million of purchase price. Our cap rate or the return on that asset would be 7%. Just how much it generates, how much it costs. That's simple. Then the cash on cash return or the return for the actual investor is now we have added the debt component. So before distributing anything of that cash flow that the property generates to the investor, we need to subtract here the capital expenditures and the debt service. So now we have this cash flow, what's available for the investors after we have paid the bank, this cash flow divided on how much equity was brought in by this equity holder. So that gives you more just my final return after debt.
Okay. Another question is, what taxes are typically paid by non-US investor investing in private equity partnership in the US?
Yeah, again, full disclosures, like we all have to say, we are not tax experts. We tend to do so, but our experience from working with our partners that have partners from 5 different countries, our CPA typically just requires the entity to withhold a 30% to the non-US partner, a 30% of all the dividends that we distribute. We have to withhold that and enter it to the IRS. That withholding, then the foreign partner can do their tax return at year end, and based on their tax situation, they may recover the full amount, or they may recover that tax retention that we did at the time where we did the withholding. So that kind of puts the foreign person in a situation in which they want to really do their annual tax returns to try to recover that retention.
We have another question here.
Sure.
Do you help international investors in their fiscal strategy to comply with the US regulations?
I'm sorry, I couldn't hear that well. Can you repeat it?
I'm sorry. Do you help international investors in their fiscal strategy to comply with the US regulations?
No, that's not our core business. We're not tax planners. We typically, again, we focus on the investment side, but what we do typically is just put our partners in touch with our CPA, the CPA that does all the tax returns for the projects and so on and so forth, and they can get their tax advice from a US CPA. We refer them both to a CPA and an attorney, but we definitely don't do that in our main activities.
I have another question from Guillermo Grimoldi. Why we should invest in commercial rather than residential real estate?
Well, it's a matter of preference. We saw the charts. We saw how they have evolved. I think residential is a good asset class that maybe even allows for individual investing, like condominiums or smaller ticket sizes. It's just a different asset class. It's like in any other investment strategy. You have a portfolio. You want to have a little bit of everything to stay diversified. And we constantly say this cannot be the only single asset class. This should be one of the asset classes that any investor should have in their portfolio. We think it's a good asset class. You could invest in this with these vehicles in multifamily asset classes. We've seen that it's not performed very well the last year or so, based on the charts, at least in Houston, but it's not nothing against residential. It's an excellent asset class that should be considered as well.
We have a reformulated question from Enrique Garcia. He's asking just the difference between sales price and invested amount.
Well, the sales price, when we refer to a sales price, is the sales price of the project. We sold the price. We sold the project at in our example. That's the project. The cost of the project. The counterparty wants 11 million for their building. That's the total price. The invested amount will not be, in our example, was not 11 million. It was 4.5. Because we had a requirement of 4.5 in equity, and then we will bring another partner that's a third party, will be the bank that will complement that capital stack to put together the entire price that is required to acquire the project. So I think that's the hopefully that answered the question.
Absolutely, and thank you, Rod. Last question. What are the preliminary risk drawbacks associated with partnership investments?
Yeah, that's a great question. We get that question a lot, and that's part of in the private placement memorandums that we draft with the SEC and so on and so forth. The attorneys always like to draft pages and pages of risks that have to be disclosed. But I would say, just from experience, the main risks, I would say, are partnerships are less liquid than REITs. If you will invest in a partnership, you have to be sure that you don't need the capital, the money, because it will be held there until you have the right exit opportunity. So it's not, if you need the liquidity today, tomorrow, it's better to invest in REITs, go to your brokerage account, and in and out. Liquidity is one. Lack of control, like it's you're giving and trusting a manager that will make the right decisions for the project, that knows the market and knows when it's or when it's not the right time to exit a project. So you're relying on somebody else's decision. So you better know who you are relying upon at the beginning of the project. So that's I would call a risk, a little bit of lack of control versus an individual investment. And then you have market-driven risks that nobody controls. And the best example that we have here in the presentation is interest rates. I wake up every day of my life looking at what is the 10-year treasury doing, and that takes me. It's something I can't control, but I know that it's a risk that it's part of the things that we need to deal with that we have no control. But you need to monitor it and know that it's out there. It's an uncontrollable risk, and I would say is the biggest risk is interest rates, because it affects the value of the property and your ability to take more debt.
Amazing. Well, thank you so much, Rob, for this amazing presentation. Thank you, everybody, for coming today to this webinar in the name of the Chamber of Commerce, the Argentina-Texas Chamber of Commerce. I think we have made a good step on how to invest in the U.S. in commercial real estate. So any questions, the information from Rod will be available for all the participants, and in a few days our backstage people like Luca Lombardi will be putting this presentation in the website for everybody to access. And again, thank you so much. This concludes our webinar for today. Have a wonderful day.
Thank you.